Chapter 5. Trend Analysis. Trend trading has transfixed traders for decades with the promise of rapid profits. 5.1 Definitions of a trend. Classification of a trend according to Dow theory. In Dow theory, trends are classified and defined by their duration and extent. Primary or major trends are longer term and span from months to years. Secondary trends or reactions are medium term and span from weeks to months. Minor trends are shorter term and span from days to weeks. In Dow theory, an uptrend is defined using In Dow theory, an uptrend is defined using peak and trough analysis. An uptrend is represented by a series of successively higher highs, peaks, and lows. Troughs, while a downtrend is represented by a series of successively lower highs and lows. This is the most popular definition of a trend. See figure 5.3. Under peak and trough analysis, Under peak and trough analysis, trend actions in scenarios 1 and 2 satisfy the conditions for being classified as uptrends because they exhibit a series of higher highs and lows. But what about trend actions in scenarios 3 and 4? There are no higher highs or lows in scenario 3 and no highs or lows whatsoever. In scenario 4, do we classify them as uptrends? Under Dow's peak and trough definition, they do not classify as uptrends. To avoid the dependence on a particular price behavior as a means of identifying a trend, many practitioners choose to use other means of trend identification, such as price remaining above or below an overlay indicator, price remaining above or below an arbitrarily chosen price level, the absence of a reversal of a specified amount during a trend. One popular example of price remaining above or below an overlay indicator in order to qualify as a trend is best illustrated via the use of trend lines and moving averages. With respect to other price overlays, the trend is considered to still be intact if price remains above the Bollinger, linear regression, and moving average lower band in an uptrend, the converse for downtrends. Price remains above the lower boundary of a chart pattern in an uptrend, the converse for downtrends. (128) Some practitioners also define a trend by its ability to remain above or below some arbitrarily chosen price level. As long as price remains above a chosen support level, an uptrend is considered to still be intact. Similarly, as long as price remains below a chosen resistance level, a downtrend is considered to still be intact. This chosen price level may represent some historically significant support level in an uptrend, or resistance in a downtrend, the violation of which would imply a very high probability of the trend reversing. A third method of identifying an ongoing trend is via the absence of a reversal of a specified amount during a trend. This third approach is employed on constant range charts such as point and figure and Renko charts, describing consolidation and trends via wave cycles and degrees. It is also important to be able to describe and identify trends and consolidations in terms of wave cycles or degrees. We may describe any trend or consolidation in terms of wave cycles, which exist at various wave degrees. Higher wave cycle HWC, highest wave degree relative to the MWC and LWC. Medium wave cycle MWC, a subwave of HWC and is of a lower degree than the HWC. Lower wave cycle LWC, a subwave of both the HWC and MWC and is at the lowest wave degree. The MWC and LWC are both subwaves. The MWC and LWC are both subwaves of the HWC and are regarded as wave cycles of lower degrees. Without knowing which wave cycle is being traded, any of the following scenarios may result: inability to select consistent breakout levels, inability to select effective stop-loss levels, inability to apply effective stop sizing, inability to distinguish between trend and consolidation mode, inability to determine the direction of the predominant trend. As seen in the figure 5. As seen in the figure 5.7, a market may be both in trend and consolidation modes at the same time, depending on the wave cycle being observed. We may also define breakouts via the degree of the wave cycles. Figure 5.8 illustrates breakouts in terms of the wave degree being traded. Hence, we have breakouts based on waves of lower, medium, and higher degrees. In other words, the breakout level will depend on the wave degree being traded. Being aware of the wave degree being traded will allow the trader to size the stop loss effectively according to the average wave amplitude and volatility associated with that particular wave degree. Volatility at one wave degree may not manifest at a higher or lower wave degree. Significance of higher wave degree reversals. When a large wave cycle or trend reverses, all the wave cycles of lower degrees reverse in sync with the larger wave cycle. Reversals, corrections, and retracements. Reversals and retracements imply a turnaround in prices. Reversals and retracements imply a turnaround in prices and may be of any amount or degree. Corrections and pullbacks tend to imply a more shallow reversal or retracement, usually no more than a few percent. Trends in terms of OLC data. Trend may also be defined in terms of individual open, high, low, and close OHLC data. Figure 5.10 depicts various trend activity with respect to the high, low, close, and mid typical prices. This is essentially a line chart in action. Hence, as far as close prices are concerned, it is clearly an example of an uptrend unfolding. 5.2 Quality of trend. 16 Price characteristics.
I impacting future price ACTN and trend.
Strength. The highest skill any trader can aspire to is the ability to read pure price action. This is an important skill because price is regarded as the most important indicator of potential future price action. 1. Cycle amplitude. Look for decreasing cycle amplitude in uptrends and downtrends. A decrease in cycle amplitude in an uptrend is an early indication that there may potentially be underlying weakness in the uptrend. See figure 5.11. In similar fashion, a decrease in cycle amplitude in a downtrend is regarded as a bullish indication. Note that the up cycle amplitudes must, on average, be larger than the down cycle amplitudes for an uptrend to take place. Conversely, for a downtrend, the up cycle amplitudes must, on average, be smaller than the down cycle amplitudes. Nevertheless, it is the change in the successive up and down cycle amplitudes that are the most important characteristic for deciphering future price activity. Contracting formations are bearish in Contracting formations are bearish in an uptrend and bullish in a downtrend. Expanding formations, where both upper and lower boundary trend lines are pointing in an upwardly direction, are generally bullish in an uptrend. 2. Cycle period. Decreasing cycle periods are also an early indication of potential weakness in a trend. A gradual reduction in the cycle period during an uptrend is an early indication that there may potentially be underlying weakness in the uptrend. 3. Bar retracement symmetry. A change in the Bar retracement symmetry. A change in the number of bars in a retracement is also an early indication of a potential change in trend behavior. 4. Average bar range. A decrease in the average bar range in an uptrend is an early indication of potential weakness in an uptrend. In a similar fashion, a decrease in the average bar range in a downtrend is a bullish indication. Figure 5.16 shows a declining ATR during a steady uptrend in the GLD. SPDR Gold Trust shares. Although volume is bullish, the ATR is indicating otherwise. A large bearish candlestick completes the bearish picture. Price declined after the volume climax. 5. Price persistence. Continuity of 5. Price persistence. Continuity of trend action. Prices tend to persist for longer periods when prices of high quality prices have relatively small bar ranges, approximately equal bar ranges. 6. The average bar stochastic ratio. Closing price compared to bar range. A Gradual decline in close prices with respect to the buy itself is also an early indication of potential weakness in an uptrend. In a similar fashion, a gradual increase in close prices with respect to the buy itself is also an early indication of potential bullishness in a downtrend. We measure this increase or decline in close prices with respect to the buy itself as a ratio, and it is referred to as the bar stochastic. Unlike the standard stochastic oscillator, which compares the relative position of the closing price over the last 10 periods, the bar stochastic measures the relative position of the closing price within the bar itself. It is essentially a 1-period %K. A simple moving average of the bar stochastic ratio is used to monitor this price action behavior. See Figure 5.18. Figure 5.19 depicts a 3-period SMA of the bar stochastic accurately identified. Figure 5.19 depicts a 3-period SMA of the bar stochastic accurately identifying bearish divergences in uptrends and bullish divergences in downtrends. 7. Average candlestick real body to range ratio. A gradual decrease in the real body to candlestick range is also an early indication of potential weakness in an uptrend. In similar fashion, a gradual decrease in real body to candlestick range is a bullish indicator in a downtrend. 8. Angular symmetry and momentum. Any change in the angular Angular symmetry and momentum. Any change in the angular symmetry is also an early indication of potential bullishness or bearishness in the markets. Generally speaking, an increase in the angle of ascent is bullish for the stock, while a decrease is bearish. Trend lines 1 and 2 are also parallel, which is a strong prognosticator of potential bullishness. A minor correction at point 3, which represents potential resistance from an over overbought angular perspective. Note that a bearish rising channel is seen developing above trendline 2, helping to strengthen the case that a minor correction is highly probable. In fact, 3M Co. went on to rise above $140 after correcting at point 3, not shown on the charts. In Figure 5.22, an upside acceleration in price is bullish, whereas an upside deceleration in price is bearish. Similarly, a downside acceleration in price is bearish, whereas a downside deceleration in price is bullish. Upside and downside acceleration is normally parabolic in nature. Such rapid increases in price usually end in a blow-off or buying climax, with prices subsequently collapsing. Similarly, downside acceleration in prices may also end in a selling climax. The price action depicted in Figure 5.23 shows an even more potentially bearish scenario in an uptrend. Here we have both a deceleration in prices, well as a diminishing bar rate. well as a diminishing bar range. In figure 5.24, we see gold with a consistent trend rate of approximately $3.30 per day. Notice that once the trend rate changes, the behavior of the market also switches to a new regime, displaying greater volatility and larger swings in price. 9. Barrier proximity. There is always a high probability that a trend may reverse
as it approaches a strong and significant price barrier.
In figure 5.25, we observe the price for A-shares MSCI Emerging Markets Fund rebounding after testing a strong and significant support level. 10. Frequency and depth of trend-based oscillations. An uptrend is considered Te- 10. Frequency and depth of trend-based oscillations. An uptrend is considered to be more reliable if it displays a reasonable number of oscillations. Oscillations should be fairly frequent and not too shallow or too deep. Such a trend is indicative of healthy profit-taking activity, with some profit taken off the table. As the trend unfolds, traders and investors tend not to react as emotionally and irrationally at higher prices where the risk of losing pent-up and unrealized profit is greater. Of pent-up and unrealized profit at risk, there is a high probability of pent-up and unrealized profit at risk. There is a high probability that traders and investors will rapidly exit the market at the slightest hint of bearishness. This makes such a trend potentially more bearish at higher prices. In figure 5.27, we see Apple Inc. prices oscillating in a steady, rising channel. This was subsequently followed by rapidly rising price with the minimum of oscillations as prices rise the second time toward the historical high. In Apple, they do so in a similar uptrend rate with relatively little profit taking. Between timelines 1 and 2, we see the ATR declining as prices rise. This is a bearish indication. We see Apple prices decline substantially thereafter. Note that profit-taking activity in the form of price oscillations also occurs at various wave degrees within a trend. 11. Relative measure of consolidation size and duration. Trend interruptions are more significant if price formations are of greater magnitude, taller chart patterns. Price formations develop over a longer period, wider chart patterns. In a strong uptrend, a larger head and shoulders formation would be deemed more bearish than a smaller formation. Similarly, a larger rounding bottom formation would be more bullish than a smaller one in a downtrend. In short, size takes precedence over form. Moreover, the longer it takes for a consolidation to unfold, the greater will be its disruptive power with respect to the trend, should a reversal occur. 12. Third gap exhaustion. The appearance of a third gap in a trend is also an indication of potential trend exhaustion and a possible reversal. Prices finally bottomed after The appearance of another third gap in the subsequent downtrend, which the appearance of another third gap in the subsequent downtrend, which again coincided perfectly with the cycle-tuned stochastic at oversold. 13. Completion of the average period range. One of the most reliable characteristics of price activity lies with its average period range, with the period being any chosen duration of observation. For example, let us assume that the average daily range of a certain forex pair is 120 pips per day. Once the average range is breached prematurely, the practitioner begins to look for various signs of a reversal, paying special attention to supportive and resistive confluences. The use of the average true range indicator (ATR) set to a reasonable look-back period on an interval chart of interest. By finding the two standard deviation value of bar range over a certain number of periods. 14. Overextended price action with respect to an overlay barrier. Any price penetration above an uptrending line is generally regarded as a potential sign of exhaustion, with a reversal expected. Exhaustion, with a reversal expected. Similarly, a reversal is expected for any price penetration below a downtrending line. It should also be noted that any short-term penetrations below an uptrending line or above a downtrending line are usually regarded as false breakouts rather than being specifically categorized as overextended. See Figure 5.29. 15. Volume spread action. The relationship between volume and price is most significant when price and volume exhibit extreme behavior. Very large bar range accompanied by very large volume. This is normally regarded as trend promoting, being a potentially bullish sign when the bar closes at or very near the high. In an uptrend, this would suggest a strong continuation of any existing uptrend and reversal of any exiting downtrend. Very large bar range accompanied by very low volume. This is normally regarded as trend inhibiting, although not necessarily as an indication of a potential reversal. It implies a lack of commitment underlying the price move. Very small bar range accompanied by very large volume. This is also normally regarded as trend inhibiting and is regarded as a significantly stronger indication of a potential reversal. It shows that even with such a large commitment in capital, there was no further extension in price, implying a strong opposition to the existing trend. This is popularly referred to as a squat bar. Very small bar range accompanied by very low volume. This is normally regarded as trend inhibiting, although not necessarily leading to a potential reversal. 16. Volume and oscillator divergence. The appearance of standard or reverse divergence between price and volume, or with any oscillators, may give an early indication of potential reversals or continuations in the market. 5.3. Price and trend filters. The exact point of entry and exit, or breakout and reversal, is determined by the type of filter and the extent to which it is employed. A trader can initiate trades based on intraday breakouts without the use of a filter, but that will not be an effective approach, as it would make backtesting virtually impossible, rendering a profitable trading performance unrepeatable. Price-based, time-based, event-based. The entry trigger characteristic associated with each category of filter is as follows. Price-based filters indicate the exact price of entry but do not indicate when an entry will be initiated. Time-based filters indicate the exact time of entry but do not indicate the price at which an entry will be initiated. Event-based filters do not indicate the exact price or time of entry until an event has occurred. Within each broad category of filters, there are subcategories, namely 1. Price-based filters. I. Absolute measure. Fixed price excursion. E. Relative measure. Percentage of breakout price. E. Volatility measure. Multiples of average true range. Multiples of standard deviation. 2. Time-based filters. I. Duration of enclosed bars. 3. Event-based filters. I. Algorithmic filters. Specific sequence of closed bars. Sequence of new highs or lows. E. Event-based measure. Closing price violation. Barrier retest after a confirmed breakout. See figure 5.30. There may be scenarios where two-stage filtering may be required in order to contain and limit the maximum risk allowable per any single trade under the rules of money management. Without controlling the maximum risk allowable per any single trade, the trading system may eventually experience risk of ruin. This is why price-based filters are the preferred mode of filtering.
As an example, let us assume that a trader has decided to use a closing violation
as the trigger for as the trigger for entry. The problem with closing violations is that prices may close too far beyond the entry level. To prevent this, an additional price-based filter is used to limit entry to within a specified distance. In essence, the trader is primarily employing the closing violation as an entry trigger, but is depending on the price-based filter to limit risk should the violation be overextended. In short, double filtering is especially useful when employing time or event-based filters, since these filters do not specify the exact price of entry, making the controlling of risk ineffective and inefficient, if not impossible. 5.40 Rent participation. Participating in the market. There are 4 basic ways of entering and exiting the markets, namely to go long, buying to open a new position; to go short, selling to open a new position; to liquidate, selling to close an old long position; to cover, buying to close an old short position. If a trader holds no open positions in the market, the trader is said to be in cash. To square a position is to exit it. Traders may also reduce or neutralize all directional risk by hedging their positions with equal and opposite positions. In the market, buying at the current price is also referred to as buying at the market. Figure 5.31 depicts
जिममध्ये वही पेन घेऊन येतो चुत्या घेऊन येतो तो बोलतो आज मला हे करायचं आहे त्याने लिहून काढलं ते
Figure 5.31 depicts the actions of a market participant trading according to the principle of buying low and selling high, which involves any of the 4 following scenarios: buying low and selling high, buying high and selling higher, selling high and buying back lower, selling low and buying back even lower. Orders for entering and exiting a position. There are 2 basic types of orders that will allow traders to participate in the market: stop entry and stop exit orders. Essentially, stop orders are instructions to enter or exit a market immediately, at any price. A stop order cannot guarantee that an order will be executed or filled at the specified price, but it can guarantee execution. When entering the market at the current price, we use a market order. Stop entry and stop exit orders may be placed in the market as pending or working orders. Once triggered, all stop entry and stop exit orders turn into market orders. Orders can also be placed instantaneously as market orders. For entry, either a buy stop or sell stop order may be placed. For exiting, if price moves adversely against a position, a stop exit order may be employed, normally referred to as a stop loss order. Pending stop entry orders are usually placed when a continuation in price is expected. Stop loss orders may experience additional loss under gapping price action due to negative slippage. Slippage is the difference between the specified order price and the actual filled price. Limit entry and limit exit orders. Limit orders are instructions to enter or exit a market at a specified price or better. If the broker cannot fill the order at the specified price or better, the order will not be executed. Orders can guarantee that an order will be filled at the intended price or better, but they cannot guarantee that an order will be executed. For entry, either a buy limit or sell limit entry order may be placed. For exiting, if price moves favorably with respect to a position, a limit exit order may be employed, normally referred to as a take profit order. Limit entry orders are usually placed when a reversal in price is expected. Profit take orders can potentially exit with greater profit under gapping price action. Only positive slippage is possible with limit orders. 1. Entries above the market. For entries above the market, a trader may place a buy stop entry order if the trader believes that prices will rise higher. Conversely, if a trader believes that prices will reverse at a certain level above the market, a trader may place a sell limit order at that price level. Being a limit order, entry is not guaranteed unless the broker can execute the order at the specified entry price or better, that is, higher. To short above the market using a stop order, a trader may use a market if touched MIT sell order. 2. Exits above the market. For profit taking above the market, a trader may place a sell limit to exit, normally referred to as a profit take order. Being a limit order, exit is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. Conversely, for cutting loss above the market, a trader may place a buy stop order to exit, normally referred to as a stop loss order. Being a stop order, exit is guaranteed but the exact exit price is unknown. 3. Entries below the market. For entries below the market, a trader may place a sell stop entry order if the trader believes that prices will continue to decline. Conversely, if a trader believes that prices will reverse at a certain price below the market, a trader may place a buy limit order at that price level. Being a limit order, entry is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. Too long below the market using a stop order, a trader may use a market if touched MIT buy order. 4. Exits below the market. For profit taking below the market, a trader may place a buy limit to exit, normally referred to as a profit take order. Being a limit order, exit is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. Conversely, for cutting losses below the market, a trader may place a sell stop order to exit, normally referred to as a stop loss order. Being a stop order, exit is guaranteed but the exact exit price is unknown. 5. Entries and exits at the market. For entry at the current price, a market order is used. The entry is instantaneous, but there is no guarantee of being filled at the indicated prices on at the indicated prices on the quote screen. Negative slippage may sometimes occur when placing market orders. Other orders include day orders instruct the brokers to keep an order pending only until the end of the trading day. Good till cancelled orders instruct the brokers to keep an order active until further notice. Market on close orders to buy or sell are executed during the last minutes of the trading day at or near the closing price. Contingent orders are orders that are executed once another order is filled or triggered. Examples include one cancel other OCO and one trigger other. Auto orders. 5.5p Rice inflection points. The 4 modes of initiating trend capture. There are 4 simple ways of initiating or establishing an entry in the market. Namely via overlay breakout entries. An entry may be initiated on an upside or downside breakout of a price overlay that may or may not be in the direction of the predominant trend. Overlay barrier entries. A barrier entry may be initiated at an overlay boundary that may or may not be in the direction of the predominant trend. A barrier entry means buying at a barrier support and shorting at a barrier resistance. Barrier entries also include buying or shorting at a retest of a barrier. Failed breakout entries. An entry may be initiated in the opposite direction after a failed breakout, which may or may not be in the direction of the predominant trend. Random entries. An entry may also be initiated in a random fashion. Pattern, sequence-based entries. Entries that are initiated after a particular sequence of bars have unfolded, algorithmic, or after a pattern is completed. For example, DMARC sequential and Japanese candlestick entries. General scenarios for market tops and bottoms. As we learned in Chapter 4, there are basically 3 variations of a market top and bottom. See Figure 5.33. Examples of a more complex top or bottom would be a head and shoulders formation, a broadening formation, an island, a diamond formation, and a rounding top or bottom. Swing points and barrier strength.
An inflection point such as a peak that is flanked by a larger number of bars
on either side of the bar with the highest price is generally regarded as a more significant peak.
As such, the resistance level associated with such a peak will be
regarded as a significant and strong barrier to price. The resistance and support
levels associated with peaks
and troughs that are flanked by a smaller number of bars on either side of the highest or lowest bar are considered to be less significant
and reliable. N bars on either side of the highest peak or lowest trough is referred
to as an inflection point of strength. N. Support and resistance role reversals. Support turns into future resistance. Resistance turns into future support. Figure 5.36 shows price finding support and resistance at prior peaks. N. Figure 5.36 shows price finding support and resistance at prior peaks and troughs, as well on the rising channel on the 30-min chart of the EUR/USD. Trading in the direction of the trend. To trade or initiate positions in the direction of the existing trend means to buy in an uptrend and short in a downtrend. It is generally easier and safer to trade in the direction of the existing trend for a variety of reasons, some being buying dips in an uptrend and selling rallies in a downtrend gets the trader into positions where positions are initiated at the most advantageous prices, with the smallest stop sizes possible. The trader is able to hold on to positions initiated in the direction of the existing trend and as a consequence extract greater profit from the markets. Buying on a deep and selling into a rally are examples of retracement entries taken in the direction of the existing trend. Figure 5.37 illustrates buying on dips in an uptrend and selling into bear rallies in a downtrend. A trader may use simple up and down trend lines or channels to time the retracement entries. The use of a cycle-tuned oscillator will also help fine-tune the entries. Trend filters. A trend filter helps to identify a trend amidst the market noise and price volatility. Below are 3 popular trend filters used to achieve such an objective, which is by no means exhaustive. Via a double moving average crossover, with the shorter crossing above the longer moving average signifying the start of a potential uptrend and the shorter crossing below the longer moving average signifying the start of a potential downtrend. Via longer-term oscillator signal line crossovers, with the oscillators crossing above its signal lines signifying potential longer-term bullishness and oscillators crossing below its signal lines signifying potential longer-term bearishness. Via the containment of prices above or below overlay barriers such as moving averages or trend lines, with price staying above the moving average or trend line signifying that an uptrend is still intact and price staying below the moving average or trend line signifying that a downtrend is still intact. One popular approach is to use the oscillator signal line crossovers in an uptrend or downtrend to time entries with the use of either an MACD signal or zero line crossover or a double moving average crossover as a trend filter. Figure 5.38 illustrates an MACD filtered stochastic crossover trigger to time entries into the market. Long entries are initiated every time the stochastic crosses above its signal line with the MACD above its zero line. Short entries are initiated every time the stochastic crosses below its signal line with the MACD below its zero line. Zero line. The stops are set to trail price by advancing to the next lower peak in a downtrend or to the next higher trough in an uptrend. Note that the divergence in the MACD helps to warn the trader of a potential reversal. Stop sizing issues related to stop placement. A stop is usually placed just below significant troughs for long positions in an uptrend and just above significant peaks for short positions in a downtrend. For entries too far from a significant peak or trough, a stop may be placed at some multiple of ATR or standard deviations away from the entry. Stop sizes associated with barrier entries will always be approximately the same size as the significant peak or trough is usually the point of entry itself. The stop losses will therefore be placed just behind the barrier, depending on the extent of price filtering employed. Stop sizes associated with breakout entries present a completely different scenario. Stop sizes for breakouts will vary with each entry, since the significant peak or trough associated with each entry may vary in distance from the entry. This presents a significant problem to traders risking a fixed percentage or fixed unit size per trade. The varying trade size associated with the changing stop size for breakout entries will affect the performance of the system, especially if a fixed percentage of current capital is exposed per trade and narrow stops are taken out frequently, causing significant loss. A fixed percentage of original capital is exposed per trade and wide stops are taken out frequently, causing significant loss. The procedure for determining the proportional trade size is as follows. 1. Do a backtest to find the average stop size for at least 300 to 500 trades if possible. 2. Calculate the 2 standard deviation value based on all the stop sizes in the sample. 3. Add this 2 standard deviation value to the average stop size. This represents the proportional stop size. 4. Determine the maximum percentage of current capital to risk for each trade and calculate its corresponding dollar value risk per trade. 5. Divide this dollar value risk per trade by the proportional stop size. This represents your proportional trade size. Therefore, the trader would initiate trades based on the proportional trade size for all trades where the stop size is at or below the proportional stop size. For stop sizes that exceed the proportional stop size, calculate the trade size by simply dividing the maximum dollar value risk per trade by the stop size. The term proportional refers to the percentage risk allocated per trade that is initiated for entries with stop sizes at or below the proportional stop size. 5.6T Rendell in S channels and fan lines. Provisionary, tentative and confirmed valid trend lines. For uptrends, a line is drawn between 2 significant troughs and projected into the future, whereas for downtrends a line is drawn between 2 significant peaks and projected into the future. A trend line is said to be only provisionary or tentative until it is tested for the first time, that is, at the third point of price contact on the trend line. Once tested, it is then regarded as a confirmed or valid trend line. All trend lines are drawn between 2 inflection points except for bullish support lines and bearish resistance lines in point and figure charting, where only one reference point is used. Short, medium, and long-term trend lines. A trend line may be defined as short, medium, or longer term depending on the amount of price activity it contains above or below it. Trendline support and resistance, the behavioral component. As mentioned in an earlier section, all price overlays, including trend lines, represent barriers to price action. As barriers, they provide support and resistance to price at the trend line, while price approaching a trend line from below will potentially Experience resistance. This occurs because most market participants will usually place buy orders above a barrier and short orders below it, invalidating and redrawing trend lines. A trend line is invalidated once it is breached. See figure 5.41 for an example of an invalidated trend line and the redrawing of a new trend line. The new trend line is drawn between the new significant trough and the original lower trough in an uptrend. For downtrends, the new trend line is drawn between the new significant peak and the original higher peak. Once a trend line is invalidated, it is thereafter referred to as an internal line. Use only price-based filters and avoid time and event-based filtering. This This would allow the trader to decide exactly how much price excursion is required to represent a valid penetration of a trend line, or for that matter, any price barrier. Even if the amount of price excursion fails to be recognized as a valid penetration, this does not mean that a new trend line cannot be drawn. Use double-stage filtering when employing time or event-based filters to gauge valid trend line or price barrier penetrations. As long as the second filter is price-based, the trader would be able to identify a valid penetration once the price exceeds a specified price. As before, this does not preclude the drawing of a new trend line, even if the intraday or intra-period penetration has not exceeded the second filter's validation price. Elements of trendline reliability. What constitutes a reliable trendline? Quite simply, a reliable trendline may be defined as a trendline that provides consistent support and resistance to price action. A trendline that experiences a lot of whipsaws is considered unreliable. Angle of trendline, a steep uptrend, that is above 45 degrees, is usually regarded
as less stable and may not be able to sustain itself over the longer term.
Any trendline associated with such a trend is therefore deemed less reliable. A weak trend with a very shallow angle of ascent is also regarded as less stable, and any trend line associated with such a trend is also deemed less reliable.
As such, a
longer-term trend line will attract a larger number of buy orders above it and sell orders below it, and in the process transform into a stronger and more significant barrier to price. This makes longer-term trend lines more reliable. Longer-term trend lines also attract the institutional players, resulting in larger orders placed at the trend line, giving rise to a stronger inhibiting effect with respect to price. Number of price retests. The greater the number of retests a trend line experiences, the more indicative it is that traders are aware and paying attention to a trend line. Such a trend line will normally attract more orders around it as traders realize that it is rejecting price in a consistent manner. Confluence with other indicators. The more confluence or convergence there is with other bullish or bearish indicators at the point of contact on the trend line, the stronger will be the rejection of price at the trend line. Preceding action, the contraction of cycle amplitude, cycle period, bar range, and body to range ratio are indications of a potentially weak uptrend and a potentially bullish downtrend.
As such, this makes any trend line associated
with such trends also suspect and unreliable over the longer term. Strengths and weaknesses of trendline analysis. Strengths. Trend lines, being straight lines, will catch any trend changes effectively. Trend lines are able to identify trends without the need to identify specific price patterns and formations. It is simple to construct and may be applied across all timeframes and markets with equal ease. A trend line is viewable across all timeframes. Weaknesses. Trend lines, just like moving averages, are also subject to whipsaws and are less Effective in erratic, volatile, or ranging markets. Because trend lines are geometrically based overlays, they are affected by the type of scaling used, that is, ratio or linear. Consolidation may cause a trend line. Consolidation may cause a trend line to be breached at some point in time, in the absence of a legitimate trend reversal. Continuation and reversal trend line entries. We may also classify trend lines as reversal or continuation in the following manner. Trend lines that allow breakout in the direction of the existing trend are referred to as continuation trend lines. Trend lines that allow breakout in the opposite direction to the existing trend are referred to as reversal trend lines. Channel construction. Channels may also be created by projecting a trend line from a significant peak or trough that is parallel to the uptrend or downtrend line. Channels are useful in that they indicate potential entry levels, profit-taking levels, future price targets, stop-loss levels. Figure 5.44 illustrates the construction of a rising channel. First, draw an uptrend line based on two significant troughs indicated at points 1 and 2. Then locate a significant peak above the trend line, which in this case would be the peak. At point 3, draw a line parallel to the uptrend line from the peak at point 3 and project it upward. This projected line is called the channel or return line. Formation constitutes a rising channel. To draw a falling or declining channel, we first draw a downtrend line based on two significant peaks indicated at points 4 and 5. We then draw a line parallel to the downtrend line from a significant trough indicated at point 6 and project it downward. Notice that the trough at point 6 has violated the uptrend line, which may be an early indication of a potential trend change. We see the rising channel transitioning into a falling channel. Nested channels. Figure 5.45 shows silver price transitions within a larger falling channel. We say that the smaller channels are contained or nested within the larger channel. Channel nesting can occur at multiple levels, with large channels comprised of ever decreasing channel sizes. In essence, channel nesting has fractal-like properties. Price target projection. Channels are extremely useful for projecting potential price targets. Figure 5.47 illustrates the use of the return line as a possible price target, providing resistance to the motion of price. The price targets at points 5 and 6 were forecasted accurately via channel projection,
Anticipating channel breakouts.
It also should be noted that if the subsequent price action fails to test either one of the channel boundaries, it may be an early indication of a possible channel breakout in the opposite direction of the failed price retest. Uptrend in a channel top in a down. Uptrend and a channel top in a downtrend represent even stronger evidence of a potential continuation of the existing trend. Notice that price failed to test the lower channel boundary, which was followed by a strong continuation of the existing uptrend. Note also the large channel breakout bar at point A. Sparandio and Demark trend lines. Victor Sparandio introduced a powerful way of drawing trend lines in his book, Trader Vic. Trader Vic, Methods of a Wall Street Master. For more details about his approach, the reader is advised to read his book. Lowest trough to the highest minor trough preceding the highest peak for uptrend lines. Highest peak to the lowest minor peak preceding the lowest trough for downtrend lines. Thomas DeMark introduced a more responsive approach to drawing trend lines in his book The New Science of Technical Analysis. The reader is advised to read his book for a full treatment of pivot selection process and other prerequisites necessary for the correct drawing of DeMark trend lines. The two most recent qualified troughs in an uptrend. The two most recent qualified peaks in a downtrend. Standard fan lines. Standard fan lines. Standard fan lines indicate a change in trend. The violation of the third fan line represents strong confirmation of a trend change. As with all types of fan lines, they provide support and resistance to price action. When support is breached, it turns into resistance, and vice versa. They are traded in a manner representative of any trend line. To construct accelerating fan lines, locate a significant higher peak and draw a downtrend line connecting this significant peak to gradually rising lower peaks. Only draw 3 downtrend lines. To construct decelerating fan lines, locate a significant lower trough and draw an uptrend line connecting this significant lower trough to gradually declining higher troughs. Only draw 3 Only draw 3 uptrend lines. Fibonacci fan lines. Fibonacci fan lines are created in a slightly different manner as compared to standard fan lines. Here is how to construct a bearish Fibonacci fan line. Identify a significant Fibonacci retracement range. Draw a vertical line from the peak of the retracement range to the trough's price level. Divide the vertical line into 38.2, 50, and 61.8% levels. Project 3 lines from the trough intercepting the 3 retracement levels located on the vertical line. Speed lines. Edson Gould's speed lines also track the progress of a trend as it attempts to bottom or top. Speed lines are created in exactly the same way Fibonacci fan lines, except that the retracement ratios are 1/3 and 2/3. Other types of trend overlay indicators. Andrews Pitchfork. Andrews Pitchfork is a geometrically Andrews Pitchfork is a geometrically based price overlay indicator. The projected lines provide support and resistance to price action. To construct the bearish Andrews Pitchfork, we need to Find a significant peak. Identify a subsequent upside retracement back up to the peak but not exceeding it. Find the midpoint between the retracement trough and the retracement peak. Draw and project a line from the significant peak through this midpoint referred to as the median line. Project lines parallel to this median line from the retracement peak and retracement trough. 5.70 rend retrace. 5.70 rend retracements. Retracements, Dow, Fibonacci, and Gann 1/3
and 1/8.
There are various approaches to measuring trend retracements. Fibonacci retracements are based on various ratios related to the Fibonacci phi ratio. Dow paid particular attention to the 1/3 and 2/3 retracements, while Gann employed 1/3 and 1/8 retracement ranges. Probably the most important retracement percentage of all is the 50% retracement level. Both Gann and Dow regarded 50% as the most significant retracement percentage, with most major tops and bottoms forming around this retracement level. We see strong convergence of retracement percentages around specific retracement ranges, especially between the 33 to 38.2%, 50%, and 61.8 to 66% ranges. 5.8 GAPS and trends. Gaps help to define various stages within a trend, which helps to provide an indication of potential tops and bottoms in the market. There are basically 4 types of market gaps, namely 1. Common gaps, gaps that occur within a trading range, considered insignificant. 2. Breakaway gaps, gaps that are created as price breaks away from a consolidation or chart pattern. 3. Runaway, measuring, midway, continuation gaps, gaps that are created in a strong trend phase. There may be more than one runaway gap appearing in a strong trend. 4. Exhaustion gaps, gaps that are created at the end of a trend, after which a consolidation or reversal occurs. It is indicative of potential trend exhaustion. We see common gaps within the consolidation phase followed by the trend-related gaps. We see prices top after the third gap, which represents potential trend exhaustion. We see the same trend exhaustion occurring at a significant We see the same trend exhaustion occurring at a significant resistance level created by a strong price rejection at the high of a very bearish shooting star pattern. It must also be noted that gaps tend to create areas of potential support and resistance. 5.90 rend directionality. A unidirectional A unidirectional entry is a trade taken only in the direction of the existing trend, be it to the upside or downside. A bidirectional entry is a trade taken in either direction, depending on which way the breakout occurs. Figure 5.58 illustrates how very short-term or micro unidirectional entries are equivalent to a longer-term or macro bidirectional trading approach. Assume that a trader only initiates a breakout in the direction of the existing trend. The trader would be initiating long position in an uptrend and short positions in a downtrend. Over the long term, this would be equivalent to a longer term bidirectional trader entering the market on a breakout. Hence we see that even though a trader only trades in one direction at any one time, being unidirectional, over the longer term this would essentially result as trading bidirectionally in the market as the trend moves up and down. The only condition that would disrupt this equivalence would be if the unidirectional trader did not take every qualified trade. 5.10 Drummond Geometry. Drummond Geometry was developed by Charles Drummond over a long period of time. Drummond Geometry helps keep the trader on the right side of the markets. It basically consists of a short-term moving average referred to as the PL line, interbar trend lines. The reader is advised to refer to the Ultimate Trading Guide by John Hill, George Pruitt, and Lundy Hill for a detailed look at Drummond Geometry. The PL line is represented by a simple 3-period moving average of typical price. To be very brief, when price is above the PL the market is regarded as bullish, and when price is below the PL the market is expected to be bearish.
Another approach that some practitioners take
is to buy when the PL line turns up and sell when it turns down. 5.11 Forecasting trend reversals. (5.11) Forecasting trend reversals. The following is a summary of characteristics associated with forecasting reversals via various forms of technical analysis. For detailed analysis of each approach, refer to the relevant chapters within this handbook. A. Volume divergence. Potential market reversals tend to be accompanied by diminishing volume in an uptrend or downtrend, indicating potential weakness in the trend. Extreme volume in the form of buying or selling climaxes, indicative of market tops and bottoms. B. Chart patterns. Potential market reversals tend to be accompanied by bearish chart patterns occurring after a strong and prolonged uptrend, bullish chart patterns occurring after a strong and prolonged downtrend, the appearance of a large broadening, diamond, or island formation. C. Cycle analysis. Potential market reversals tend to be accompanied by cycle peaks at market tops, cycle troughs at market bottoms, decreasing cycle amplitude during a trend, decreasing cycle period during a trend. D. Oscillator analysis. Potential market reversals tend to be accompanied by overbought signals at market tops, oversold signals at market bottoms, bearish divergence with price at market tops, bullish divergence with price at market bottoms, oscillator crossing below its signal and equilibrium line at market tops, Oscillator crossing above its signal and equilibrium line at market bottoms. A. Candlestick formations. Potential market reversals tend to be accompanied by bearish candlestick formations at market tops. Bullish candlestick formations at market bottoms. F. Intermarket relationship. Potential market reversals tend to be accompanied by bearish action in the broad markets leading to a top in the stop. Bullish action in highly correlated markets leading to a bottom in the stop. G. Support and resistance levels. Potential market reversals tend to be accompanied by market tops at significant historical resistance levels. Market bottoms at significant historical support levels. 5.12 Chapter Summary. In this chapter, we dealt with issues concerning the definition and identification of a trend. We have also discussed various powerful trend indicators that helped identify the early onset of a trend. The practitioner is advised to pay particular attention to the 16 characteristics that may significantly impact the future of price action and potential strength of a trend.